I'm excited to actually have you because I enjoy listening to you. I don't have a plan today. Paul's in Colombia. So, what I'd really like to do is just kind of go over some trending topics for the week that are going on, and then just like hear your thoughts on it.
Well, I mean, the absolute biggest thing is the FTX saga, and it really is a saga at this point that really goes deep. It goes deep into government. It goes deep into politics, and pretty much how all this transpired. It was pretty much allowed due to a combination of greed, flat out fraud, and then
Well, let's start with this. Let's say because I've heard about it, but I don't really know how it got to this point, or really what FTX was, how it's involved in the space, who's using it. So what would be really great is if you could break it down like I'm a 5 year old, right? So FTX is this, and then here's what happened. I think that would be great.
absolutely. So, FTX was started back in 2019 by Sam Fried, and what he did, he created this exchange. So, it's a centralized exchange, pretty much operating kind of like a Fidelity account, TD Ameritrade account, where instead of going to purchase stocks, you can now go and purchase cryptocurrencies.
Okay.
So he created this exchange, and the purpose of it was
But
to
it's so just sorry, just so it's similar to Coinbase.
exactly. So
It's exactly okay.
it's exactly similar. So in the crypto space, you have two types of exchanges. You have centralized exchanges, which the majority of people use because they are the most accessible. And there's a few exchanges in America that are regulated. FTX was one of the most regulated exchanges. However, it wasn't totally approved by the SEC. Coinbase has the highest standard of regulation in the US. It's fully approved by the SEC, and they have the strictest standards as far as reporting their balance sheet and all those things. FTX actually they didn't have that strict as Coinbase did as far as reporting their holdings.
So what made people choose FTX over Coinbase?
That's a fantastic question. So, and this kind of goes at the heart of how this all blew up, to how big they got, how quickly they got so big, and then how it all sort of collapsed. What FTX did is they focused a ton of money on marketing. They focused a ton of money on branding. They brought in a ton of celebrities, and then also too, they had some major connections with the SEC, and I'll go into that in a little bit. But it was pretty much a marketing blitz that made FTX seem like they were the chosen exchange. It was pretty much, and I said even in the last podcast, this was kind of marketed as the institutional hub. Even though you have Coinbase and the custody apparatus was pretty much the gold standard in the space, FTX was kind of marketed as this like institutional hub where a lot of these crypto projects held their treasuries.
So was Coinbase almost positioned where it's for individuals, almost like Robinhood was, right? Like for stocks, versus FTX was positioning themselves as, like you said, a Fidelity, or did you get what I'm trying to say? Like, was
Yeah.
Coinbase positioned like this is great for individuals, but this is better for a different demographic?
No, I would say that they are positioned the exact same way. It's just that they were marketed a little differently. So Coinbase has institutional grade sort of custody, and then they have the retail wallet there that's also, from the looks of it, it seems like it's pretty secure for people to have their private keys and be able to store their assets on Coinbase where they actually have control over them. Again, it was all about the marketing. FTX had the arena in Miami that they put hundreds of millions of dollars into. I mean, in the World Series, you had umpires all have FTX patches on their gear. FTX did marketing like no other exchange. Binance really didn't do hardly any marketing there. Coinbase did some. They obviously had the Super Bowl commercial and some stuff like that. But FTX really followed a blueprint of marketing a product to as many people as possible. And the goal of FTX, now that we see how everything happened, was to get as many people to trust FTX with their funds, to get as much money onto their platform as physically possible. And then what transpired with that money after that is the real crazy story.
So that's why they had these big names like Tom Brady and stuff like that, right? To
Yes,
add credibility to the platform.
absolutely. And you notice no other exchange did that. FTX did that for a reason, because they wanted to have all eyeballs on them. They wanted to have the credibility from even investors. You obviously have Mr. Wonderful, and Kevin O'Leary really be a major mouthpiece for them. You had Anthony Pompliano, who on every one of his podcasts always promoted FTX as the premier exchange, as the safest exchange. So there was a lot of coordination between some very important influencers to promote FTX as safe and as the place where if you want to get involved in crypto, to store your funds. And this was actually promoted in-house as well. So here's something that you might not have heard is that FTX employees were encouraged to direct deposit all of their paychecks into FTX, to trust FTX as they would a bank.
Okay, so now you have these big names who understand the value of their brand, right? They typically don't go into something that could hurt them. So what happened? They had
So
to they had to believe in the product. I'm
yeah,
assuming, right? Kevin O'Leary is not going to go out and promote something.
and it really came down to Sam and his connections. Sam had a pedigree that would be very attractive to any investors. He kind of built his reputation as being an outstanding trader, where he made his money off of trading. He wasn't really a coder. A lot of people thought that Sam, he was a kind of master coder. He was more of a trader. He had built a reputation in that regard, and then really what drew a lot of people in are it was a pedigree of his parents. So his mom is Barbara Freed. His father is Joe Bankman. So they are both Stanford lawyers and professors at the university. Now, Barbara Freed, her story is pretty interesting. So back in 2019, she started a political super PAC that was called Mind the Gap. It was a Democratic super PAC that worked with Silicon Valley and tech companies to raise money for various Democrats. When that happened, it coincided with the launch of FTX. Then you have his father, who was he was a compliance lawyer as well, and he had many connections within the Democratic Party. Barbara Freed, she also had represented Hillary Clinton. I forget to the exact nature of the capacity, but had deep connections into politics. So now imagine if you're an investor and you're seeing an MIT educated genius now having the pedigree also too of two Stanford law professors who have deep connections into politics. So it's set in the frame. If you're an institutional investor, one of the biggest barriers, especially in crypto, is to get the regulators and the politicians on your side. So it makes perfect sense here to now imagine FTX getting a leg up on pretty much any other exchange, any other VC company, because Alameda is the VC side of it and the investment side of it and the incubator side of FTX, which we'll get into as well. But I could see how these investors would all be kind of enamored with the pedigree of Sam, his parents, and the connections he has to think, okay, if I'm going to make a bet on something that something's going to pan out, I would pick FTX.
Okay, so what started going wrong? What happened?
So it pretty much all happened from the start. So what pretty much happened? Okay, so now FTX was operating as an exchange. Alameda Research was this giant incubator where their prize project it was Solana and the Solana ecosystem, which we all know about, right? So Sam had invested a ton of money into bringing Solana into market and had built the whole ecosystem. So Solana, it was all connected to FTX, and pretty much the brand of FTX was connected with Solana. So Sam had a vested interest in making sure that Solana was highly successful, the ecosystem was highly successful as well. If Sam was smart, he could have made FTX, it'll be a run-of-the-mill exchange. He could be making figures easily a month off of the fees of the exchange. But what we know now, what ended up happening is Sam was funneling funds from FTX to Alameda, which is highly illegal. So he was in essence investing. He was investing all the consumers' funds without their knowledge, and you can't do that without a specific contract. It has to be registered with the SEC. It's in essence operating as a syndication where you're investing other people's money with the promise of a return, but this was never even discussed. So they would pretty much funnel in all of the money from FTX into Alameda. What they were doing there is now they were investing and bringing new up and coming projects to market. They were acting as the market maker. So in essence, what a market maker does is they provide liquidity and they provide the trading market for a new crypto. So what I could think that they were thinking was that, okay, like we have the opportunity here to now bring all of these startups to market and benefit from the crypto bull market and the appreciation that all of these new sort of cryptos were getting. And you couple that with the fact that the brand recognition and the clout that Alameda had, if you're a crypto project, you're going to want to have Alameda behind you. So this was kind of the whole narrative that was being built here, was that Alameda was the kingmaker in the space. So now they were attracting all the top projects, in theory, to have Alameda, bring them to market, right? And now Sam was able to now funnel all the money from FTX over to Alameda to actually make this happen. So that was kind of, in a nutshell, how this whole thing was doomed from the start, because again, that's obvious fraud right there. Now, what's even worse was what Alameda was actually doing. So what Alameda was actually doing was, in essence, they were sabotaging pretty much every project except the Solana project. They were even sabotaging the Solana ecosystems. So I went into this as well in the last podcast, how you had a lot of pumps and dumps on the Solana ecosystem, where you have these projects where you had a lot of like VC backing within Alameda Research. You would see that these projects would start low and they would blow up. You're talking 20, 50, even 100x on some of these projects, and then all of a sudden they would collapse. Now you had three also main projects that had similar experiences, which you had ICP, Internet Computer, which other than Ethereum, I believe, has the most experienced and the largest team of developers in all of crypto. These were highly experienced people. They have a very good product. Then you had Casper Finance, which was very similar. Breakthrough technology. It's a layer one that can now it can adjust its smart contracts in real time. That's obviously it's over a lot of people's heads, but it's a great technology. And then you had Newcoin, which it was a similar interoperability sort of crypto with smart contracts built in. Now the commonality between these three projects were that these three projects could be viewed as a threat to Solana and the ecosystem. So now, what was discovered? What Solana, what FTX was doing, and Sam was doing, and he was doing this with his own token, the FTT token as well. They were counterfeiting tokens. They were through Alameda. They were counterfeiting tokens to control the supply. So now, what they would do in the beginning is they would market make, right? The projects would see appreciation of their tokens, and then all of a sudden they would see a drastic drop, crash in their tokens, and they didn't know what the hell was going on. But what the CEO of NewCoin found out was that they were counterfeiting tokens to now dump on the market. So now they weren't real tokens, but Alameda and FTX, they were profiting off the sale of the tokens because they were controlling the market for the tokens. And this was happening with the FTT token, where pretty much Sam created this token out of thin air. And what he was doing with the FTT token was he was using it as collateral to get more money. Again, to now funnel into Alameda, to buy up projects, and to control pretty much everything in the market.
This isn't something like there was a mistake that was made and they were like, oh, fuck, like,
Absolutely
now
not.
we got to write it. I mean, they were intentionally
Yeah.
scamming people. Like, there's no doubt about it.
No, there's absolutely no doubt. I mean,
Is that correct?
I'm sitting here. I'm putting myself on the line here, and I'm telling you, there was
Okay.
no doubt that this was the biggest financial fraud possibly ever committed. This is bigger than Bernie Madoff. This is bigger than Enron too. We're talking about a whole of $32 billion, possibly upwards of $50 billion. Now, what they were doing on the trading side was even crazier. Now, I had my suspicions of FTX. I never used it. I kind of was exploring on derivatives for a while, but I didn't actually do anything with it. But I stayed away from FTX because, some other people I was talking to, some other traders, they were getting stopped out on trades unusually. So what this happens is, say you put in a trade, right? They would all of a sudden get what's called a scam wick. So an unusual move in price that would all of a sudden magically hit their stop loss, right? So it would stop them out of a trade when they were in profit. And then all of a sudden the price would just bounce back up. This happened across Binance too as well. And people thought that Binance was doing it. There's a possibility, I can't confirm it, that FTX was also behind these scam wicks on other exchanges. So what Alameda was doing, they had a feature. They had a feature in FTX where they could not be liquidated. So now, if you are trading and you're trading on leverage, you're in essence borrowing funds from the exchange to make a trade. There's a certain amount of risk that you have to expose yourself to at that, and you can be liquidated if you don't have the risk management in place. Alameda and FTX have programmed the trading platform for them not to have any kind of liquidation risk. Highly illegal, right there. So that's something that they were doing right there. And now this plays into another player in the game here, Dan Freiberg. I don't know if you heard of this guy before, Dan Freiberg. So Dan was the lead counsel of Ultimate Bet. So Ultimate Bet was found guilty of scamming between 20 and I think upwards of $50 million off their clients. And these were also pro players, like I believe it was Phil Hellmuth and Mike Manasow were scammed on this site. Now they had a program in their software that was called God Mode, which allowed people to see other people's cards. So they were in essence programming this to now scam off people, whales especially. So they were doing that. It was the same playbook as FTX, where they drew a lot of celebrities in. They drew a lot of the best players in the world onto their site and to market their site as the place to go and play poker. And what they were doing is they were scamming people on this site. It's so ironic how you have this similar setup with Alameda and FTX being able to, in essence, view the order books, being able to front run trades, and being able to rig the trading game in Alameda's favor. So Dan, he was the chief compliance officer at FTX. Don't ask me how this guy is allowed to still operate after he was implicated in the Ultimate Bet scam to now being a chief compliance officer for FTX. So pretty much the same exact model, how Ultimate Bet operated and how FTX operated. That's something that a whole lot of people don't even realize right now too.
All right. So now we kind of got how it started, how it ended, but like what's next? So what happens now?
So right now, so there's supposed to be a hearing in the first week of December in Congress to examine, if fraud had occurred here at FTX. So this gets interesting as well. So obviously, it's going to go before Congress, and the lead investigator is Maxine Waters. So Maxine Waters is a very prominent figure in the Democratic Party. She's been around, I want to say, like 40 years or so. Uh, she has many photos of her and Sam Bankman-Fried together. This goes to the next aspect of it, where not only were the funds of the customers being funneled to Alameda Research without them knowing, it looks like funds were also being funneled into donations for the Democratic Party and some Republicans as well. This was kind of, it was go back to what I was saying, Sam's whole kind of master plan here, it seems, was he was buying influence. So he donated in the past election $40 million. In 2022, I'm talking about like in the recent election that we just had, he donated upwards of $40 million. This obviously was some of the customers' funds that are now missing at FTX as
Yeah.
well. And now on top of that, we bring in Gary Gensler, who's the chairman of the SEC. So he was Hillary Clinton's chief financial officer for her campaign back, I believe, in 2016. And he met with Sam multiple times. They had met multiple times, and especially recently, where Sam was trying to create, and he was promoting this. He had an interview with Eric Voorhees on his podcast talking about the need for more centralized regulation, which he got a lot of pushback for. So the theory was Sam was secretly working with Gary Gensler behind the scenes to create a regulatory monopoly for himself. Sam, he was that close to pretty much having full control over the regulations for crypto in America based on his relationship with Gary Gensler, who he had been meeting for months, multiple times. This all goes back to who appointed Gary Gensler. He was a product of the Democrats and their leadership. They have promoted him. You have Elizabeth Warren, who interestingly is a real kind of hardliner against crypto, who actually employs Gary Gensler's daughter on her staff. And Gary Gensler has kind of had this posture where he's been very coy, and pretty much it's all of these people who Sam had connections with all were very skeptical of crypto and were kind of bad-mouthing everybody else except him. And then now that he started donating on the level he was donating, all of a sudden now he has this backdoor in, and now he's influencing policy. So this is kind of where we are now.
Okay, and I know Paul had some opinions. Do you share in it as well that somebody may come in and take over FTX because it's still a sound platform? Or
I would say that FTX as a brand is pretty tainted right now. And then on top of that, there seems to be a lot of shady programming in there that, again, allowed FTX and Alameda to operate in a pretty nefarious way, where this isn't like an exchange where now like we can go in here and now just kind of operate it and just get the people out. There almost has to be kind of pretty much a fresh audit of the code, of everything that's in there, to ensure that that all the customers who are using that are safe, and they're not being traded against, and they can have their assets, just all taken from them without having their knowledge. So I feel like there's too much of a stain on the brand and on the platform where it could be saved, but maybe there's something that replaces it. And then also too, it's like we don't really know how much of these funds we're going to be able to recover. You had Ripple, I believe, who was inquiring about trying to purchase a few of the funds, if they could, and a few other companies were kind of inquiring about to see if they could purchase what some of the remaining assets were and try to save them. But we don't know the nature of what's even available right now.
last question. What does this do for the overall ecosystem, right? Like, is crypto tainted right now, right? Is this space tainted right now because of something like this?
Absolutely. So one of the biggest things that kept normal people out of crypto was it was the risk factor, right? Now, it was a risk factor once you got off of the centralized exchanges. Most people felt comfortable going on a centralized exchange, buying some Bitcoin and Ethereum and storing it there and kind of setting it and forget it. Now with this, now it's like, what's safe? And it seems like nothing's safe. So now for somebody who doesn't know really how to navigate the space, how to protect themselves, I would always recommend, buy a cold hardware wallet, store all your assets off of there. But that's a process that you have to learn how, and then also too, how to get your money onto an exchange, how to buy an asset, how to take it off. It's not that hard to learn, but it's still a process for people. And that's something that I feel that a whole lot of people aren't going to want to, even get involved in. So in theory, as far as the retail involvement in the space, I think we're going to see a major lull for a while. As far as the value add proposition for crypto, that's not going away. And I think too many people are out here saying that, oh, it's dead. And that's almost it's almost like a major bottom signal and it's happened before. It's happened in 2015. It's happened in 2018. Happened in 2013. Where you had these massive market collapses and everybody thinks, oh, it's dead, it's over. Let's put something in perspective here. So back in the day, there was one exchange where 90% of the transactions in crypto and Bitcoin took place. It was Mt. Gox, right? So that exchange got hacked and everyone lost all their funds. So imagine one exchange where 90% of the transactions in crypto was hacked and people lost everything. And crypto bounced back from that. We are so much bigger now and there's so much more adoption and interest. There is no way that this is going away. So I think, again, you have to kind of zoom out and look at the big picture here. This is terrible. This is, in theory, is worse than Mt. Gox as far as the timing of it and the nature of the fraud. That was a hack. This was a massive fraud. The only positive thing I can say was that it was stopped. This could have gone on for years. If this could have literally gone on for years, we could have had a pretty nefarious character pretty much had to have his tentacles in every facet of government controlling everything we do in the crypto space, which would have been terrible. We've stopped that now. So now the space has to heal, confidence has to be restored, and now hopefully meaningful regulations will be in place now to now where the institutions feel comfortable and the retail feels comfortable to actually explore the space and come in and really start to invest, because now everybody is out. Institutions are really pausing right now because they were scammed, and now you have the retail that still is scared out of the space and not coming back in anytime soon.